And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome back to the show this morning. It is, of course, Thursday as we get ready to go into the second best day of the week. That's right. Tomorrow's the weekend, right around the corner. Just getting there. Every day a little bit closer. Of course, it's been just hot in Texas. This heat wave is already coming in, and this is just, by the way, just if you're from California or New York and you've moved to Texas recently, and you know, we appreciate you being here. It's great. Just understand that where we are right now in the cycle is we're in the preheat mode for Texas. So, you know, it's going to get hotter as we get to the summer. But, yeah, it's already starting to heat up here. Energy prices continue to go up. Electricity costs going up. This is all the inflation problem that we talk about that consumers deal with. Of course, we've hit record gas prices now for the last 30 days. So out of the last 31 days, we've had record gas prices, 30 of 31 days. Today's a new record for gas prices, inching very close to that $5 a gallon national average. So now, depending on where you live, now average is the average, right? So in some states like Texas, gas price is a little bit lower. Other states like California, you're paying a whole lot for a gallon of gas. So again, kind of going up everywhere. But even the cost of charging an electric Tesla is now going up as well as electricity costs are on the rise. So you're not getting away from it no matter where you go. And I thought it was interesting, the White House still trying to claim that record gas prices are a Putin tax. This really has very little to do with that in general. There's some part of that is true, but there's a lot of other problems and factors that are going into the rise in gas prices, and that's been primarily a contraction of leases available, making it harder to drill for oil companies and domestically to increase oil production, and of course the shutdown of pipelines, etc. Those have all been the contributing factors to crimping the supply of oil that we have. And again, remember, just a couple of years ago, we were a net exporter of oil. We had too much oil. We're exporting oil because we have that excess capacity. Now, this is the problem with not having enough. So again, you know, it's not just Putin. Sure, Putin and the Russia-Ukraine invasion is having some impact on oil prices. Certainly not helping by any stretch of the imagination. But there's more to this story than just blaming this on Russia. High inflationary issues, not a function of Russia at all. That's all that monetary policy that we did a couple of years ago, increasing demand at a time where you have no supply. That's increasing the inflation run. We'll talk more about that this morning because apparently as we touched on this yesterday a little bit. We'll get into it more with Michael Leibowitz this morning, but Janet Yellen, apparently our Treasury Secretary, has either forgotten basic economics or is just stupid. One of the two. We'll get into that this morning. But turning back to the markets here, yesterday, markets really traded lower yesterday. And I thought this was interesting, and this is also something Mike and I will talk about a bit this morning. The market sold off yesterday, kind of opened up a little bit yesterday morning, and they kind of really fell about 1% by the end of the day on comments from the SEC. Now, this is Gary Gensler. He's the chair of SEC, and he was at a speech yesterday talking about making the retail trading space, right? He wants to make the market a fair place for investors. And I think that's a wonderful idea. Now, the likelihood of this actually occurring is slim and none because, remember that Secretary Gary Gensler is, or Chairman Gary Gensler is a political appointee as the head of the SEC. But and so when it comes time to get reelected, of course, Wall Street contributes a lot to political campaigns. A big chunk of the political campaigns that they get their money from comes from Wall Street. So if Gary Gensler wants to keep his job, this probably won't happen. But he's talking about moving trading to an auction, a real-life auction for these major firms. And this would have really significant impacts. We're going to get into what those are this morning and what that means, particularly for companies like Robinhood, who depend on payment for order flow. So we'll talk about that this morning and why that means that commissions will likely come back, and more importantly, why that's probably a good thing. So we'll get into that this morning with Michael Leibowitz as well. So a couple of things to get into today, but what we're going to, over the last day or so, and it's been a really interesting last week or so, really going back to last Monday, the markets have literally gone nowhere. We've just been trading in a very, very tight range here between the 50-day moving average and the 20-day moving average, just a very, very tight level. And, you're up one day, you're down one day, you're up one day, you're down one day. And we're literally not going anywhere for the last 2 weeks. So this started last Monday, continuing through today. Markets are going to look to open up a little bit this morning. Bitcoin and cryptocurrencies trading up as well. They've become very correlated with what goes on in the stock market. But again, just really stuck here. Haven't been really able to make a move in either direction. And the problem with this, as we talked about yesterday, we touched on this yesterday morning, is that we're eating up this fuel that we had for this rally. And if we take a look at our kind of indicators that are suggesting how this market advance is going, we're already starting to see these indicators begin to tighten up and suggest that we may be getting a point to where this, kind of the next corrective phase will occur as well. So again, markets can do two things. They can either rise or fall, right? Or they can just consolidate sideways. And even that consolidation sideways eats up a lot of that fuel that you had for that rally. And that's an unfortunate thing here because while we had a decent rally at the start and relieved some of that pressure on the markets, just haven't been able to do a lot with it. And so that really kind of brings in some concern here, particularly with moving averages just overhead. That's beginning to press down on prices, making it harder for stocks to rise here. But again, going into next week, we've got the Federal Reserve on Wednesday going to be talking about their next policy change, which will probably be a 50 basis point rate hike. Then on Friday, we've got a massive $3.2 trillion options expiration. That can really affect the markets either direction. You either have a market that's down a lot or up a lot that day, depending on how these contracts have to get rewritten and pushed out for the next cycle. Again, so that's going to increase a whole lot of volatility next week. So I really don't expect much from the markets between today and next week, again, other than just a lot more up and down. But a lot will depend on this. Friday, we've got the CPI report tomorrow. We'll see what that says. Is that going to show us that inflation is rising again? Or are we going to start to continue kind of to see this kind of peak inflationary pressure coming in? We've got a bit of dichotomy going on. We've got rising energy prices, but that's a very small weight in the CPI index. But we've got home prices that are coming down. Homeowners equivalent rent make up about 25% of CPI. So once you strip out food and energy, we may see weaker inflationary pressures. We'll see. Again, there's a lot of inputs into this, a lot of variability, but we'll see what CPI prints tomorrow. But that's also going to feed into potentially what the markets think about what the Fed will do, and this will also push back into yields and interest rates and a whole variety of things. A lot of stuff to get into over the next week or so. But again, Mike and I will touch on this this morning as well. We'll come back. We'll talk about Janet Yellen and Jerome Powell, the Fed, right after the break. I'm your host, Lance Roberts, right here on The Real Investment Show.
Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hurricane season is here, and along the Texas Gulf Coast, we know how to prepare. What we don't always know is which way the storm will go, and if a hurricane does come your way, whether your house will flood. Fortunately, you can get flood insurance. Unfortunately, flood insurance rates have skyrocketed. Don't be at risk. Let the specialists at RIA Insurance assess your needs and shop your coverage for the best rates possible. Another service from realinvestmentadvice.com. Click on the insurance tab, realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It is 6:17 as we get things underway here. Michael Leibowitz joining me this morning as well to talk a little bit about, all things markets and finance, of course, as always. But I wanted to kind of kick off the segment talking a little bit about Janet Yellen yesterday. We touched on this yesterday morning, and it got me so fired up, I'm writing an article on it. But it was interesting. So they're questioning Janet Yellen now. If you don't know who Janet Yellen is, she is the former head. She was the former Fed chairman prior to Jerome Powell. She succeeded Ben Bernanke. And then she was smart enough to bail out of that seat before we got into 2018, and Jerome Powell kind of took over the ship since then, has just had one kind of crisis after another on his hands. But Janet Yellen was promptly moved into the seat of Treasury Secretary by the Biden administration because she's a big supporter of the administration. And, so she's been trying to defend a lot of the policies coming out of the White House and have been talking up things like, the Treasury Secretary's responsibility to get involved in climate change and a variety of other issues that have absolutely nothing to do with that job, but weighing in. So she was being questioned yesterday about inflation, and they said, "So what's what's causing all this inflation?" Of course, the narrative from the White House has been this is all Russia's fault that we have inflation, but that's really not the case, considering that we had inflation well on the rise way before Russia was even an issue this year. Right? Inflation was rising back in 2021. And, there's a direct correlation between, the injections of $5 trillion worth of liquidity into the financial markets and the economy and this inflationary spike. But Janet Yellen claims that no, Biden's Build Back Better plan and his American Rescue Plan had nothing to do at all with creating this inflation. And, I was just sitting here, thinking about it. It's like, here's somebody was the former Fed chair, supposed to be an economist, and really doesn't either remember or want to admit to the very basics of supply and demand of economics.
It's quite funny how political they get when they change seats, huh?
Yeah, exactly.
It's, you know what, she's saying what she has to say from her seat, but many economists out there on both sides of the aisle, I think, clearly understand that this is largely a function. Russia is playing a role in it, but it's largely a function of the policies of the pandemic policies in which not only did the Fed run, $5 trillion of liquidity, but the government printed it all.
Right.
So a lot of people like to say the Fed printed. The Fed doesn't print a thing.
Right.
It's the money is always lent into existence. So money starts with a loan. And the U.S. government borrowed $6 trillion over that 1.5, 2 year period, which is astronomical, even compared to astronomical deficits.
Exactly.
And that's your money printing. Abetted, the Treasury is the one that went into the bank with the gun, but the Fed was right out front with the car running, helping them out every bit of the way.
Yeah, that's a good analogy of that as well. And I thought it was interesting, though, she's talking about this fact that we have inflation, and it's not the problem of this kind of money printing that we're talking about here, but she goes on to make comments, suggesting that, well, this is, and of course, this was also, she got thrown into the bucket with the Fed talking about transient inflation. Now it doesn't seem to be so transient anymore. So now she's backpedaling and saying, well, inflation's not transient, at a time that probably we've just seen the peak of inflation within a month or two, right? And so she's just constantly now going to be on the wrong side of this trade. But the interesting thing is that from her position, right, her job is Treasury Secretary, so she's the one that's actually printing the debt. She sees what's going on with the U.S. debt and the U.S. deficit, and that we're running a $30 trillion, a debt problem right now, that, we just continue to spend more than we bring in terms of revenues. But just a complete, as you said, though, this is kind of a political angle for her, but just a denial of what this whole kind of inherent problem is. And this is something that existed well before, Russia was a problem. And I find it interesting, there was an excellent chart out this morning I put on our Twitter account talking about Russia. We're all upset about Russia, Ukraine. And we supposedly have these sanctions on Russia where we're not supposed to be buying stuff from them, but yet imports into the U.S. from Russia are strongly on the rise for the last 3 months. So, despite the fact that we're very angry, we still need to buy stuff from them. So, the imports coming in. It's not just the U.S., though. It's Denmark. It's most of the Eurozone countries. Their imports are just surging coming out of Russia. So I'm not so sure what the penalties are on Russia right now economically, because we're still buying a lot of stuff from them.
Just on things we don't need to buy.
Yeah, exactly. Maybe that's the case. So, but yeah, I do think though that her stance is interesting, because again, as we talk about monetary policy and as we talk about the Fed, needing to hike rates and trying to quell this inflationary pressure, we've got this, this idea that it's all Russia, but if we can if Russia solves their problem ultimately, and this will, whatever's going on between Russia and Ukraine, whatever the end game of this is, it's going to end eventually. And the question is when it ends, how soon does it end? And then what's the time that it takes to just kind of get things back to normal? Because, we'll ease up sanctions, oil will begin to flow again, oil prices will come down again. But this is always that cycle we get into, Mike, where we think that things are just going to go in one direction. People forget that just a year ago or so, we were talking about negative oil prices. Now we're talking about oil prices that have nowhere to go but up, and people are putting out $300 a barrel oil because of the world that we're in. And that's simply just not going to happen. You're going to have a recession, you're going to have an economic crisis of some sort, and that's going to kill demand, and oil prices will come down.
Right. And I think when you kind of look back on the last couple of years, the problem is that the government wants to manage the economy. They want to manage economic growth because it fits into their narrative. And this is true across the aisle. They all want to manage the early 2020, the economy fell off a cliff. So the government came in and they bombarded it with money, and the money was spent. And we can debate that all day on whether the right thing was done or the wrong thing, and depending on where you are in that political spectrum, from libertarian to communist, there was some role the government probably had to play there in early 20. But the government kept going, and they kept going. And it was 2021, I think that was the late 20 and early 21. The economy was coming back as quick as it could. There were still a lot of things shut down, and it wasn't going to come back fully, but maybe we should have just accepted that. That's the price we had to pay for protecting ourselves from a health perspective. And it was going on around the world. It wasn't just us. And we knew that supply lines were really problematic, especially in some of the foreign countries where we import a lot of our goods from. But the government just kept their foot on the gas pedal because they wanted to sell the narrative that everything was back to normal.
Right.
Nothing was back to normal economically. Nothing was back to normal health-wise. But that was the narrative, and they did it, right? Despite nothing being normal, they got economic data not only back to normal, but back to 40-year type like record levels.
Right.
An economy we've never seen before. And there's your inflation, right? So now they got to fight inflation. And how are they going to do that? They have to slow down the economy.
Right. Well, and again, this is, and of course, the question becomes is, how do you navigate that landing, right? The hope is always that the Fed will be able to kind of guide this airplane that's, pointed, nose down at the earth at this point and say, okay, we can put this back on a glide path and slow this thing down and have a nice soft landing and everything will be good. Unfortunately, it just never really kind of works out that way, because they're working on lagging data, and what we're seeing real-time data telling us is that the economy is slowing down a whole lot more than what the Fed is probably thinking it is. And this is always it's kind of always the problem, is that they start doing these things. They're hiking rates, they're reducing liquidity, which all starts next week, by the way, that, leads to that problem. Either you get something breaks in the credit market, the housing market collapses, whatever it is. And that causes this much more drastic slowdown than what people were thinking. And then they're in the problem of being caught flat-footed and having to backpedal, trying to fix things, but then it's too late.
And I think there's zero appreciation for us, for Lance, you and I and Brent and everyone listening to the show. We are the consumers, and the consumers are at least 2/3 of the economy. And I think what most economists do not appreciate, because most economists make a couple, 200,000, 300,000, 400,000 a year. Some make a lot more. They all work for the big banks on Wall Street, or they're at the Federal Reserve, where they're doing very well for themselves as well. They don't appreciate the plight of the consumer, the struggle that when we're all getting pay cuts, right? Unless you're getting 8%, 9% raises, your pay is being cut. It may not seem like it because you got a 5 or 4% raise last year, but your pay is being cut and you're struggling. Mm-hmm. And this isn't just the lowest income classes. This is working its way up through the middle classes too, and probably even to some degree to the upper classes.
Yeah, that's right. It's interesting too. One last thing here on Janet Yellen before we pop off is for the break is that, she said that, the money that was spent by the Biden administration didn't cause the inflation, because there's inflation everywhere in the world. But there's a chart that's out. We put it out on Twitter yesterday, showing that the inflation in the U.S. is about 5 times as high as it is everywhere else in the world. And it's not surprising that everywhere else in the world has inflation, because we import so much stuff from other countries. Germany's like, a $3 trillion economy, and we've got a $20 trillion economy here in the U.S. So yeah, if we start importing stuff from Germany because we're all buying stuff, guess what they get? They get inflation. So
you can't make this stuff up.
You really can't. Gotta love Janet Yellen, though. Every time I see her, I just think I'm going to get some cookies. Grandma Yellen. Anyway, be right back after the break. Hey, we're going to shift gears, talk a little bit about SEC Chairman Gary Gensler, and what he said about making Wall Street a fairer place and what that might mean for you. We'll be right back after the break with Mike Leibowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny's always telling me I can't retire, but I've got bad news. I'm heading out to LA to be a lifeguard.
Yeah.
I've been working on my bikini body. I'm going to look good in my Speedo.
Oh, yeah.
Yeah, $500,000 a year.
You know, I hate to break this to you, but you know how pilots have age restrictions?
Yeah.
Pretty sure lifeguards do as well. I think you're just over it.
The Real Investment Show podcast
Hey, Maverick's still flying airplanes.
Sure.
And he fly jets at 59. I can be a lifeguard.
at realinvestmentadvice.com.
You could be a CG lifeguard.
Exactly.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Michael Leibowitz joining me. So over the last couple of days, there's been initially some rumors, and then yesterday at a speech being put off by the SEC chairman, Gary Gensler, talking about making Wall Street a fairer place. So, you know, and we have to go back here for a couple of years and you know, just to kind of remember kind of what brought this to a head. Of course, this all began, you know, a couple of years ago with the whole GameStop incident, the meme stock trading, Robinhood shutting down trading on some stocks because there was order flow problems, so forth and so on. But, you know, part of this whole discussion that we're talking about goes back to a issue that has actually been around for quite some time. And that is this idea called payment for order flow. And we've written a couple of articles on this previously. And what payment for order flow is simply this. Mike has a brokerage firm. He's Robinhood as an example. And he's going to take in retail orders from retail investors. So what he does is he's got everybody coming in. They're all wanting to buy, GameStop or Yahoo or whatever, right? So they're all wanting to buy a stock. He bundles these orders up very quickly. This is all happening in microseconds. So there's 5,000 orders coming in to buy ExxonMobil, whatever it is. He bundles that block of orders up, and then he sends it off to another firm, like a Citadel Securities as an example, who will then execute that trade onto the exchanges. So they go out and they buy the shares of ExxonMobil, and then they send the shares of ExxonMobil back to Mike and the Robinhood app, and then he allocates those shares across all the accounts. So in a matter of a few seconds, you see the shares of ExxonMobil show up in your account, and you're none the wiser. Well, what happened, though, is that when Mike sold that order flow to Citadel went out and executed a trade before that against that block of shares coming in, either long or short, whatever they were doing, and they made a profit on that. And they do that, and then they pay Mike a payment, right, for this order that was given to them, of which they profited from. Now, they wouldn't pay Mike this fee if they weren't making money on the other side. So something has to be happening here. Just logically, it tells you that if they're paying Mike $100 million a year, which is what Robinhood got, if Robinhood's getting $100 million from Citadel for order flow, something has to be happening with Citadel Securities and that order for them to make a profit, right? This just makes complete sense. So this has become much more of a point of contention, but this payment for order flow is why you get free trades. And it's not just Robinhood doing this. It's Schwab, it's Fidelity, it's everybody. And this is why you now have free trading. But it's not free because you're not really getting best order execution. Yesterday, Robinhood was down sharply because what Gary Gensler's now talking about is in order to fix this problem, we need to get rid of payment for order flow. And he's right. And how would we do that? Well, we would go to an auction-based system. So in this case, Robinhood could no longer get payment for order flow. All those orders would go into an auction, and all the other dealers would provide their best bid or offer to execute that trade. And whoever has the lowest price or the highest price, depending on whether you're buying or selling, would then get that order to trade. But at that point, there's no advantage. Right? A firm can't front run that order because they're giving you the absolutely best price for doing that, which means a couple of things. And we'll talk about what those issues are and what that means to you here in a second. But I want to let Mike weigh in on this issue first. Mike, how are you this morning?
Good. I think what he's doing is outstanding. I think they needed to do this years ago, and they haven't, and it's great. And what's been going on in the markets is very misleading. It's, in most other industries, whoever regulates them would be all over them because they're essentially false. The price you pay is not real. Mm-hmm. So you go in to buy Exxon at market. That's how most individuals buy a stock. They buy it at the market, and you look up and you say, okay, Exxon's $100 a share. I'm going to buy it. Well, you end up buying it at 99.99 cents or 103 cents or whatever it is. And you think, cool, I got it at market. And even better, I don't pay commissions anymore. I'm winning. I'm a big winner. That's not what's going on. The price you pay is not really the market price. The market price was somewhere lower than that. So yes, you're not paying a $5 or $8 commission, whatever they were, but you're paying pennies a share. And that's where Citadel, for one, gets the $100 million to send Robinhood the money.
Right.
Citadel, by the way, is making more than $100 million.
Oh, yeah.
Right. They're not being very generous in giving Robinhood all they're making. So they're making, I don't know what they make, but it's a lot more than $100 million. Those are the pennies that they're taking from investors.
And go ahead.
It's not just Robinhood. It's all of the brokers. And if you notice, they all went down to zero commission. And it wasn't just about keeping up with Robinhood. It was because they were making a lot of money on the order flow.
Yeah. And here's what's really interesting about this. So Citadel is by and away the largest payment for order flow firm on the street. They make billions every year paying for order flow. Why do they do that? Obviously, because they make billions, right? So if I can pay for order flow and make billions, I'll do that all day long. But here's the interesting thing. In 2004, a letter from Jonathan Katz to the SEC. He states, because payment of order flow creates fundamental conflicts of interest that cannot be cured by disclosure, the Commission, the SEC, should ban payment for order flow altogether. It is crucial that this ban include not only exchange-sponsored programs, but also payment for order flow arrangements entered into privately between order flow providers and market centers. Now, who does Jonathan Katz work for in 2004 that makes this such an interesting statement? He's the attorney for Citadel Securities. In 2004, Citadel Securities was a hedge fund. That's all they did. And they were arguing that payment for order flow should be banned. And when it didn't get banned, they said, well, you can't beat them, join them, and let's make a whole lot of money doing it. And this is the problem. They know. See, Citadel knows that payment for order flow is a predatory practice against retail investors. And, as we've talked about before, free is not free. There is no free lunch on Wall Street. When you're getting something for free, you need to ask the question, who's making money off of this deal? And that's everybody else. That's Wall Street. That's how they make money. And they're making a lot of money doing it based on what you're trading. And so you're actually getting worse prices because of this. Now, what's the consequence? So first of all, we'll talk about the reality of this actually happening. But if we went to an auction-based market, here's going to be the change to you. Free trading will have to go away. We will have to go back to a commission-based system where you pay some commission, because that's how the order executors, right? So when you want to place your order, somebody's going to have to pay, somebody's going to have to pay for that order execution. That's going to be you. So you're going to have to go back to paying a commission. That's not a bad thing, because A, you're going to get better pricing on your purchases and sales, but B, what commissions also do is slow down trading. The one disadvantage of free trades is that it encourages people to trade because, hey, there's no cost to trade, so why not just buy it and sell it and buy it and sell it? There's no cost to it. The problem is that leads to over trading, which leads to worse performance over time and causes losses for investors. And this is why we've consistently seen holding time shrink for investors, because the cost of trading has been going down for years. But if you provide that break for the automobile, you'll actually wind up with not only better returns, but better pricing. Now, Mike, why is this probably never going to happen, though?
Because who owns the SEC? No, the answer is not the president. It's the people or Congress. It's the people that fund them, that get them elected. Exactly. And at the end of the day, we both know that Citadel, JP Morgan, Goldman Sachs, all the other big boys have bigger pockets than me and you do, Lance.
Yeah,
and
absolutely.
And when it comes to running for office, Republican or Democrat, independent, doesn't matter. They need money to run. And they can't afford to have those big firms on the, funding the other side of their election.
Well, and the other side of this too, another reason that this stuff never happens is the SEC goes to Wall Street and says, "Hey, I want to pass this new rule. What do you think about it?" And they only take the response. They don't listen to the small retail advisors, anybody like that. We don't know what we're doing. They only listen to the JP Morgans and the Bank of Americas and the Wells Fargo and get their opinion. They basically talk to the Wall Street mafia. And they say, well, what do you think about this rule? Well, this won't be a good rule. Not going to be a good rule at all. It's going to have all these problems. It's going to reduce liquidity in markets. Of course, they're going to argue it very eloquently with the SEC, and the SEC will back off of this. But again, You're right. This comes down to both political contributions. Don't forget that chairman of the SEC, Gary Gensler, is a political appointee. And if he wants to keep his job, likely this will not happen. It'll be unfortunate. It would have been a great fix. It's a great idea. It would bring back some fairness to what we consider to be the financial markets. But again, It was fun to talk about it, though. Be right back after the break. Next week, Friday, CPI. Next week, the Fed. Next Friday, we've got the massive OPEX expiration. Talk about all that with Michael Leibowitz right after the break, what that means for you and your money and the markets going into next week. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hurricane season is here, and along the Texas Gulf Coast, we know how to prepare. What we don't always know is which way the storm will go, and if a hurricane does come your way, whether your house will flood. Fortunately, you can get flood insurance. Unfortunately, flood insurance rates have skyrocketed. Don't be at risk. Let the specialists at RIA Insurance assess your needs and shop your coverage for the best rates possible. Another service from realinvestmentadvice.com. Click on the insurance tab, realinvestmentadvice.com.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. Man, this morning has flown by, just gone by quick this morning. Michael Leibowitz joining me. A couple of things to kind of wrap up the show with this morning. Mike has an article out on our website we published out yesterday morning called "The Consumer's Getting Squeezed." It's a really good summary about where we are economically. And again, if you take a look at what's going on with consumer credit as a good example, $54 billion increase last month, $35 billion this past month. Consumers are just being tapped out at this point, having to go back to, getting into credit card debt just to make ends meet. And look, you're going to see a lot of articles out there, and I've already seen a couple of them come out, and they're like, oh no, the consumer's in great shape. And they show like the, household debt to income and ratios and things like this. You can't look at those with any type of seriousness, because if you take a look at the dispersion of wealth in the economy, the top 10% of income earners skew that data so badly that it's no longer really a viable measure. And so we've broken this down before, looked at the bottom 80% versus the top 20%. And if you get into that bottom 80% of the economy, those are the people that are driving the economy, because they spend they spend virtually all their paycheck just to make ends meet, versus those at the upper end, which have a lot of savings. And that's what's skewing savings rates, disposable income. So you've really got to break this stuff down into looking at strata. But if you start digging into the consumer spending data, which Mike did yesterday in his article, it's actually much more telling about where we are currently in the economy. Mike, and kind of a quick breakdown here. What was the conclusion of the article?
That consumers are running out of means. They don't have the means to spend. So like I said a little while ago, everyone's getting a pay cut, whether you know it or not. You may be getting a 4 or 5% raise, but you're getting dinged 8, 9% on inflation. So the question is, if you want to continue the life you had before, where do you get money to fill that 4% gap or so, right?
Mm-hmm.
You borrow money via credit cards. And like you just said, credit card spending has shot up. Its annual growth is the highest it's been in, I think, 10 or 15 years. You draw down your savings. Savings are now down to 8 to 10-year lows. And that's not on an inflation-adjusted basis. They're actually, when you inflation adjust it, the value of those aggregate savings are even much lower. So the two traditional sources of extra spending are getting whittled away. There's still more. We can still use more credit cards, but there's some people maxing out on their credit cards. There's some people that have drawn all their savings. We also used to use refinancings on our mortgages at 5.5%. No one's refinancing a mortgage, and not unexpectedly, the MBA refi index is at pretty much the lowest level it can be. So the point is, the consumer is struggling, right? We're paying $100 to fill up our cars now. Go out to dinner, lunch is now $15. It used to be $10 and under. That money is money we're not spending elsewhere. Mm-hmm. And we're making hard decisions on what we want to buy, what we have to buy. And it's just getting worse as inflation stays up at 8%. Even if inflation stops rising, it's still higher than our wages. And until wages can catch up with that, the consumer needs other means. And all the article is saying is that these other means, and including government support, because we're not going to get anything through Congress before the election. And after the election, those odds may even fall if the Republicans take the House or Senate and we get a split House and presidency. So the consumer's really in a bind here. And just going back to point one, the consumer's 70% of the economy. So when you start thinking about the economy and you want to do your own GDP forecast, think about that lower middle income class family and what they're doing and the struggle that they're facing right now, because that's the marginal driver of the economy.
Yeah. And I think that's, this is the one thing that we tend to overlook. And, and again, I put out a chart on Twitter this morning. Goldman Sachs is still expecting 3% growth in the second quarter. And we've got the Atlanta Fed right now talking about 0.9. I think Wall Street is going to be, much more surprised about where we wind up. And again, even through the end of this year, growth rates are expected to be, Goldman Sachs has very high growth rates for the economy. But if you look at where we're trending currently, it is certainly heading in the wrong direction. And again, the longer that inflation remains high, which, at this point it's going to remain high for a while, these things aren't going to fix themselves overnight. This is going to continue to erode into consumer spending. And then, of course, the next thing that occurs that nobody's talking about is that at what point do companies start laying off workers? We've already seen hiring freezes picking up. But when do they start cutting wages and laying off workers to protect profit margins, right? I mean, that's, and then that makes it even harder for consumptive spending to stay up as we get further in. So there's really not a whole lot of upside here over the next several months. Particularly now we can shift gears to the Fed here real quick. Particularly with the Fed now looking to hike rates by 50 points next Wednesday, reducing their balance sheet by $60 billion this month, and then increasing that to $90 billion a month by August. You're just extracting more liquidity out of the markets. And increasing borrowing costs for consumers, really kind of across the board. There doesn't really seem to be a lot of upside here.
No, and if you remember, first quarter GDP was negative. If we get a negative print in the second quarter, which will come out a little more than a month from now, that's a recession. Mm-hmm. So what's funny is I get a lot of people on Twitter saying, we're not going into a recession. There's not going to be a recession. The consumer's doing great. Well, the Atlanta Fed thinks that economic growth right now, based on the data they have, is 0.9% for the second quarter. And what we've seen from Target's a great example. Target warned us less than a month ago that they are having inventory problems. They have too much inventory, that their margins are getting cut. This was literally 3 weeks ago. They came back yesterday or 2 days ago and made those warnings even harsher. So something happened over the last 3 weeks that their inventories rose further, that their margins are going to get cut more. That's because the economic activity, especially for those lower middle class retailers, Target, Walmart, which again, that's what drives the economy.
Mm-hmm.
It's not the high end, the Rolls Royces, the Tiffany's that are driving the economy. It's where we go food shopping and to buy those essential items. They're the ones that are getting hit. And Target could not be more clear that there are problems.
Yeah. And yeah, it's not just Target. You know, it's Amazon talking about too much inventory, too much staff. Right. Walmart, too much staff, too much inventory. And it's not just inventory at those retailers. If we take a look at inventories for building supplies and retailers across the board in terms of clothing, apparel, etc., all those inventories have risen markedly. About the only thing that has a reduction in inventory is used cars, because those had gotten sold off and prices were very high, and now the replacement. People can't sell their cars because if I sell a car, I can't buy a new one. And so everybody's starting to hang on to cars, which is keeping inventories lean on used cars. But, that's about the only area where we're not seeing inventory starting to creep back up, and not just a little bit, but actually creep up pretty sharply into an oversupply status. Of course, that's deflationary, because how do I get rid of inventory? I've got to start discounting stuff. So, if I go to Target in the next few months, I may find some great sales and some stuff here sooner than later, but that's disinflationary in and of itself.
And the housing market is really starting to turn around. Believe it or not, there's a house in my neighborhood that's been on the market for 2 months now, and there's nothing wrong with it. It's a nice house, and
it's haunted.
I wouldn't say the price is fair, but it's what it should be.
all those houses where you live are like 100 years old, so, they're all haunted.
They're all haunted. This one's not haunted, it says. No, but the housing market...
It claims it's not haunted. We'll see.
You can see the housing market is certainly changing. And according to the University of Michigan, it's the worst time to buy a house ever. Yeah. That's based on survey of potential home buyers.
Yeah, and this is an interesting point here. When we take a look... When we go to live, right now, the average person, and look, we've heard this argument over the years repeatedly. So, when we get these CPI reports, people always are always upset because, well, you haven't gone to the grocery store lately. You haven't paid for gas lately. Well, food and gas, we strip that out of CPI to get to core, right? Core CPI. But more importantly, energy is a very small weight relative to the other components of CPI. Housing, as an example, homeowners equivalent rent, makes up more than a quarter of the CPI calculation, right? So if housing prices are coming down, oil prices could literally stay where they are or even go higher. And we could see inflation come down if housing prices come down and homeowners equivalent rent follows suit. Now, it's going to take a few months to filter through. But, Mike, if you're right about housing prices starting to come down, affordability coming down, those type of things, we could see an impact into CPI even though oil prices remain high. And that's going to be, consternating to a lot of individuals going, I can't make ends meet because I'm spending all my money on gas, but CPI says it's coming down.
Right. And, the problem has been twofold. It's mortgage rates that are 5.5% and house prices that haven't turned around. Mm-hmm. So this is 15 to 18% of the economy revolves around real estate. So it's not just that 2/3 of the economy is the consumer, but within that somewhere is that 15 to 20% is real estate that is almost due to crack. Yeah, it's completely unsustainable.
Exactly. All right, Mike, thanks so much for joining us today. We'll be back tomorrow, Financial Fitness Friday. Of course, we have the CPI report out tomorrow. We'll have our newsletter. We'll cover what the markets did this week. If they do anything, that'll be in the newsletter this weekend. Our daily commentary is out this morning. Lots of good points in there from the consumer spending, Janet Yellen, what the market did yesterday. Simply go to our website, click on the daily commentary banner right there on the front page. Get our latest daily commentary. Subscribe to get it sent to you by email before the market. And also check out SimpleVisor, our digital platform. We have all our new portfolios are up. Just simply go to our investing tab, do it yourself. You can see all our portfolios we have available for you on our digital front as well. Lots of stuff at the website. As always, realinvestmentadvice.com. While you're there, send your questions and comments, realinvestmentadvice.com.
It's a rich man's world.